Guy Adami here, Tuesday, April 27th. Macro Setup brought to you by our presenting sponsor, IGUS, one of the fastest growing foreign exchange dealers in North America, joined, as always, by my dear friend, Dan Nathan. Dan, how are you?
I'm doing great, Guy Adami. Great to be here. We are in the midst of it. We are getting in the mix right here.
And listen, just so you know, in about 960 seconds-ish, we're going to bring in the great Christopher Vechcio, the senior strategist of Daily FX. I'm looking forward to hearing what he has to say. But let's get into it, Dan. Here we are. As I say all the time, why is the market higher? Because it's open. And once again, here we are, Dan Nathan.
Well, the market seems to be taking a little breather today, Guy. It's just unchanged here. We have the S&P 500 up over 11%. We have the Nasdaq 100 up a little under 10% on the year here. And that seems like a pretty healthy 4 months for the S&P 500. We know we're in the thick of earnings. Like I said just a second ago, we are in the mix of it. We're going to have it all happening this week. I think a third of the S&P 500 reporting earnings so far. And listen, you know how sometimes, Guy, I like to kind of throw up a few like headlines, news headlines to kind of gear our conversation here. I'm going to throw a few tweets up here today. How do you feel?
I like it. Listen, I love that. And can I pronounce this gentleman's name? Because I've been practicing. So if you wanted to, yes. So you tell me when to do it.
Let's do it. Here is a tweet from
Chamath Palihapitiya.
Yes. So Chamath, who is a widely followed, let's call him a finfluencer, a financial influencer here. He's obviously a very successful investor, founder of VC firm Social Capital. He is the SPAC king, I think as the Wall Street Journal has called him. He's done a bunch of SPACs, Virgin Galactic. He's trying to buy SoFi or made a deal to announce SoFi earlier this year. But here's a tweet from yesterday. I think it's really interesting. It says, market feels coiled. Lots of money on the sideline. 10-year yields can't find a bid, and rotation from growth assets are the setup. So meaning rotation back into growth, out of value, cyclicals, that sort of thing. He's saying, or he's asking the question, what's the catalyst? What does that mean to you, Guy? Does it mean that 10% up on the year, 11% up in the year, the S&P 500, we're waiting for these Q1 earnings, we're waiting for 2021 guidance, and we're about ready to just blow out from here?
Yeah, well, I mean, when you say the market feels coiled, I mean, typically that means it's ready to explode to the upside once again. It's been taking a breather, ready to explode to the upside. Lots of money on the sidelines, which has been an argument for as long as I've been in this business. Whether it's relevant or not, I'm not sure, but a lot of people have said that. 10-year yields can't find a bid. Okay, I hear you. We topped out around 177 or so in the 10-year, traded down to 151. As we're taping this now, Dan, 10-year yields are about 158. So they might not find a bid, but I also think they found a bit of a floor. And rotation, what's the catalyst? To me, that's the critical line of this entire tweet. Ended with a question mark, and I'll try to give you an answer. Well, the catalyst can't be financials. It's not going to be energy. It's not going to be consumer products. The catalyst for what he's talking about are the tech earnings coming down the pike, right? I mean, that's literally it. The only thing that can take this from a coiled spring to an explosion to the upside is a blowout earnings for 5 or 6 of the names we talk about all the time. Oh, by the way, the F-MAGA complex, as you coined it, over a year and a half, maybe 2 years ago, Dan.
2018. All right, here's a really interesting kind of thought about that, Guy, and you're right. Okay, so Amazon and Apple make up about $4 trillion in market cap. All right, that's pretty substantial if you think about it, especially in the NDX. I think they're probably combined close to 15% or something like that. They have not confirmed a new high in the S&P in a very long time. Apple back in January and Amazon all the way back in September. So if you were to see those two companies or those two stocks break out on better than expected guidance, well, that could help it, okay? And the other one would be Microsoft, Alphabet, and then Facebook. Both of those big ones, this is Alphabet and Microsoft, are already at all-time highs. And Facebook, which is obviously considerably smaller than the two of them, but still pretty large by its own right, very near its high. So if you had all 5 of them moving together and you had that rotation, that might help that breakout, and it might help this, the S&P has been kind of, it's been coiling here for just a little bit. I think when you talk about a coiled spring, I think it means more like some of these commodities that we're going to talk about later. They got beaten down, they got beaten down for so long, and ultimately there's no sellers left, right? So the shorts start to cover, speculators come in, and then you have those kind of ricochet moves. So to me, listen, I just thought that was a really interesting one. I'm just going to transition. Here's another tweet from Jim Cramer of CNBC.
Can I read this one, or are you going? I like to read sometimes as well. Can I do this, or you want to go?
Yes, please.
Many of the forecasters I follow are saying we're at the peak of the economy. If that is the case, then Jay Powell might be right. Okay, I hear what he's saying. In other words, if we're at peak economy, the fact that the Fed is keeping their foot on the gas pedal is the right thing to do. We'll see. It's interesting when he says many of the forecasters I follow. I'm not really sure who he's talking about. And I'm not sure a lot of people have said peak economy. I'm waiting to hear that. A lot of people have said peak market. A lot of people think the economy is going to continue to get better. So I hear what Jim is saying. Basically, what he's doing is he's making a case for the Federal Reserve to keep doing what they're doing. Obviously, Jim comes down on the entire other side, as I do, in terms of the Federal Reserve and their role in the markets and stuff. But as they say, Dan, that's what makes a good argument. And I think Jim makes a point just putting something out there to sort of, I don't know, get the embers going, sort of get people like me ready for the word, Dan, because I know you know what's coming, exorcised.
That's right. Well, here, this was a good old-fashioned, subtle game of would you rather, Guy Adami or Jay Powell here. I think the way Jim framed this is really interesting. So he's talking about a bunch of strategists, economists who've come out of late just saying that expectations for 2021, we just had Mike Wilson on CNBC's Fast Money last night, just talking about the rebound here and where we are. We're going to get back to, we've had this really sharp, we're expecting, mid-single digits GDP, maybe even a bit higher, right? But that's going to settle back in. So I think that's what they kind of mean as far as peak economy. Fair. And then you start revaluing things on basically that 2% GDP growth that we've had for a long time. Now, what's different this time around is that we've just had tens of trillions of dollars of stimulus pumped into the global economy as a percentage of global GDP. That's pretty substantial. And I guess the point is that at a certain point, Jay Powell's going to have to make a decision. And I think this is where you're at, right? Is that all that stimulus and with the economy going the way it is on the other side of the pandemic, and we're going to talk about this in a second, is what does that mean for inflation, right? And sooner or later, that Jay Powell's going to actually be forced to do something to combat inflation that's run away in a lot of different areas if it's not transient, right, Guy Adami? So that's the debate that we're going to be having for the balance of the year.
Yeah, listen, I was young once, believe it or not, when I was in college. Like, I was one of those people that like to leave the party early, not late. You don't want to be the last person at the party because, it's just uncool and everybody wants you out. And unfortunately, I think that's what's going to happen here with the Fed. They're going to stay at the party far too long, and people are going to wish they were gone. And I think it's going to be really deleterious to the broader market. Jim might be right. Listen, Fed's done everything right in terms of navigating this and what's happened with the market. I think the Fed is one of the main reasons we have this wealth gap that everybody seems to be talking about right now. But again, that's what makes markets as well. I'll tell you, we're going to get into it with Christopher Vechcio in a little while. If you look at what's going on in commodities, soft commodities, base metals, precious metals, it's telling an entirely different story. But it's just a bit of a tease here, Dan. So please continue.
Well, let's go to that next tweet here. This is from Bloomberg, and it's really talking about what you just said. You didn't even know that was coming, Guy.
No, I did know it was coming. I set you up. I teed it up for you like the kids in T-ball in the spring when you put the ball on it and they hit the rubber thing and they look around and the whole thing flies.
Right, so Bloomberg's note here is saying that this stunning rally in copper is showing no signs of letting up here. So what do you take? What's your take on this? I mean, does this sort of move? This is not what we would have seen. Let's just say we had a normal. We had this sort of, economic correction, if you will, that without the pandemic and without all this sort of stuff. This is not the sort of rally that we would have seen in industrial commodities, right? This is literally has to do with the fact that there's negative interest rates all over the world, right? There's been tens of trillions of stimulus, like we just talked about in fiscal. We have further infrastructure plans. That's what's going on here. At some point, Guy, how do you ride copper for a breakout of this 10-year range?
Look, the right thing to do, just looking at this chart, and you brought it up on CNBC's Fast Money last night, if you've enjoyed this run in copper or in names like Freeport-McMoRan, the correct thing to do is take some money off the table. I mentioned it last night, that FCX was trading at levels we last saw in 2012, and then you bring up this copper chart, and that just backs up what I was saying. I mean, if you're trading and just look at this, you say, you know what, time to pull the ripcord. And I understand that, and that's the frugal thing to do. I would submit that we're in the early innings of this, and it's not just a U.S. story we're talking about. It's other developing nations and developing continents like Africa. And if you think this copper story is going to go away anytime soon, I think you're wrong. I think we're in the early innings, and I hate using the term, but of a commodity super cycle, all predicated on the things we talked about 5 or 6 minutes ago. And oh, by the way, it's not just the US anymore. It's China, it's Africa, and it's other developing nations. So if you think copper is going to stall here, yeah, maybe it will, just, challenging that prior high. But I think the sell-off's going to be short-lived, and I think the continuation to the upside will continue.
Maybe. I would just say that when I look at this chart, I'd say you see those highs that we got to in 17, early 18 before it topped out. I think that's as good as it gets for the global economy, meaning like that's where we had this U.S. tax cuts. We had all this dereg. We had, like this is just kind of massively overshot here. So to me, we'll get into these charts later with Chris. Let's go quickly because this is the last one here, Guy, and this is also from Bloomberg, and they just had a note out. Our friend Joe Wiesenthal had this in his morning newsletter, which I actually think is fantastic. It's one of my first reads, but it was talking about the ag economy. So industrials, Chris is going to hit those. Let's go to the SPX, buddy. Let's go to the S&P 500.
Let's do that. And as we pull up the chart, well done by our friends at Open Exchange. Yeah. Covino and Brendan are just stellar. But just if you want to back up and reinforcement of that chart that we're going to talk about take a look at what's happening in Archer Daniels Midland today. That comes out ADM and Bunge, BG. Yeah. If you want to sort of we don't. I'm not saying we do have them, Dan. People can do that on their own. They're capable of doing that. Okay, I'm not calling for the charts. I'm just saying you may want to take a look. Anyway, I'm sorry. Please, let's talk about the SPX.
All right, let's look at this one. I mean, this breakout that we had in late March, above that high from earlier in the month, it literally went up in a straight line. It's been banging around here a little bit over the last couple of trading days. And we just talked about all of those earnings that are coming this week. You look at that uptrend that had been in place from its May 2020 lows. I obviously could have gone back a little deeper here. It's held that like a boss. It intersects right at that breakout level from March here. What do we got? 12, 13% above that 200-day moving average. And that rising 50-day is just above that breakout level. I mean, to me, that doesn't look coiled to me. That looks like it already went parabolic.
Yeah, it looked coiled. If you really want to get into coiled, I mean, it was coiled back in like October, November. That's when it was coiled. You had the S&P challenging, not trading at the 200-day moving average, and you saw what happened, right? To me, that's coiled. Here, as you mentioned, we're some 13% above the 200-day moving average, which we haven't really challenged in any meaningful way since last June. And that's historically an extended period of time. So again, I've said this, I'll say it again. The farther we get away from that 200-day moving average, the more bearish I get. And maybe Chamath is right. Maybe we'll come out with gangbuster earnings later this week. And instead of a 4,200 S&P, we'll be talking about a 4,351. But that will just reinforce but that'll just reinforce,
I guess the point is
my bearishness.
Who's the incremental buyer of any of those names at this point? I think it's important to note that Tesla, we were talking about it felt like an hour on Fast Money last night. After their results, it looked like, all the metrics were good and that stock is down, 3-4% today. My point is the stock had just rallied 25%. It's like, who's the incremental buyer here, especially with the market where it is 4 months into the year? Let's go to the Nasdaq 100 chart, Guy. I know you got a lot to say on this. The Nasdaq composite as a whole has not made a new all-time high, unlike the major indices. The NDX has. Those 5 names, the FMAGA complex, make up 45% of the weight. Throw Tesla in there, it's about 50%. So you have about 5 or 6 names that make up half of the Nasdaq 100, and that thing has been range bound. It had corrected, and if you look where it's kind of straddling right now, that breakout level from February, you see that 200-day moving average down there at 12,300. We're right around 14,000. Again, about 12, 13% above the 200-day. How do you trade this? Because to me, I'm just not sure. Again, back to that incremental buyer of the big names is there. And then I'm going to make one other point. There's been a lot of new issuance, whether it be IPOs in the tech space, right? Whether it's DoorDash and Airbnb and Coinbase and Snowflake and C3 AI, Palantir, a lot of names, hundreds of $1 billion in market cap of companies that are not profitable that have come in the last 6 months. Those stocks are all 30% at least from their all-time highs a few months ago. So it feels like the fever has broken for high valuation growth. We know that the SPAC names have not been trading well. So to me, going back to what the rotation is, you're telling me then the biggest names in the market have to drag the whole market up.
That's what I'm telling you. That's what everybody's telling you right now. Yeah. That's what that coiled spring comment is telling you. And listen, if Carter Worth were on this podcast with us or on this webinar, what do we call these things, by the way? We should get him on. But he would say in a very cogent manner, we're looking at a bit of a double top here, and they better hope that earnings blow out later this week. Otherwise, we are going to test that 12,300 level or so that you so well orchestrated with that horizontal line, and it coincides with the 200-day moving average, which, by the way, if you don't think the S&P has challenged its 200-day in a while, just take a look at this. I mean, we've been significantly higher for an extended period of the time, all bolstered by, the names that Dan's been talking about. And again, the point you made about some of these under-radar stocks trading anywhere from 30 to 50% off their all-time highs, that's what Mike Wilson said on the show last night. So you better hope that your horses continue to lead the way, that your Garrett Coles and your Jacob deGroms and your Clayton Kershaws continue to throw lights out. Otherwise, we might have some trouble in the fuselage. That's an Odd Couple reference, by the way, for you folks playing our home game.
I thought you were going to go with the Kentucky Derby as you were getting into the horses, but
you like that?
Whatever. Yeah. Hey, well, here, let's just touch on this one quickly, because this really speaks to that rotation, right? So out of like cyclical value, and if you look at the Russell 2000, we have a 1 year, and you look at that, it's really been going sideways now, and in a volatile manner, since kind of mid-January or late January or so. What does that mean to you? That chart, how much is that above its 200-day? I mean, that's even more egregious, you might say.
No, egregious is correct. And this is the one, listen, I mean, we've talked about this, but it's worth pointing out again, the move to the upside in the fall coincided with yields moving higher. And then if you look, it's sort of stalled out, because I've mentioned a number of times, you get to this point of diminishing marginal returns in terms of yields. And if you look at where we topped out, that probably coincided-ish around the first time or the second time we traded north of 155 or so in the 10-year. And now the Russell is trying to figure out, wait a second, are yields going higher good for us or bad for us? And I think the sideways action you see illustrates exactly that. I think yields are going higher. I think higher yields will be bad for the Russell. And I think the Russell could potentially lead the broader market lower. That's been my thesis. I'm going to stand by it.
All right, that looks like a head and shoulders formation that we got going there. That double bottom that we saw in March, is the neckline there. We have that little box drawn. Let's go to yields here, Guy. I have a 2-year chart of the 10-year U.S. Treasury. You think it's kind of pulled back to that lower bound, that 1.5% on the 2-year chart. Looks like support, and you think we're kind of staging for a move up to 2?
Yeah, I do. If you look at, we're going to talk about the soft commodities with Chris in a couple minutes, but then you look at the housing numbers that have come out. I mean, some of the inflation data that's come out, people will say it's not as hot as the market thought it was going to be, but you know what? It's hot nonetheless, and there's no getting around it. I mean, you just all around, you look at some of the commentary out of a lot of these companies who are sensitive to prices. They've all said the same thing. There's price hikes coming. Inflationary pressures are working against them. And again, the fact that none of us talk about it, the Fed doesn't talk about it, that's great. I think the bond yield's going to do the talking for them. I think we traded down to 151 and held. And I think the next move is through that 178 level that we saw, a month and a half or so ago.
Hey, just so you know, the Fed is talking about it. They're just using a word that you disagree with. They're calling it transient, okay? So that's what they're saying.
Please, you're trying to wind me up on this Tuesday. I'm in such a great mood. It's like, remember in Fast Times at Ridgemont High, I woke up in such a great mood. I don't know what happened anyway.
Come on. All right, so listen. So here's the 10-year chart of the 10-year U.S. Treasury yield, and it shows that 1.314 dating back to 12 and 16 that were kind of bottoms there. And here we are, we're still above those levels, but you think we break out of this range here. Let's go to the Dixie, the US dollar index, guy, because this is one that you were fading that little bounce that we had from what, 89 or so up to maybe, did it get as high as 94 here?
I want to say I got to 94.5, but I might be mistaken, but it got damn close. So.
Yeah, and this is a 10-year chart, and you look at that range between 88, which was the 2010 high, and then it was the breakout level in 14, and there was a place that found support back in 18, right? And now here we are threatening it again. That's a bad-looking chart. I mean, you get through those lows from 2018, and there's no support for, a ways away.
That's a bad-looking chart. And in retrospect, when you had been saying for week after week that this was a very crowded short position in terms of the U.S. dollar, you wound up being exactly right, because that move from like 89 or so up to 94.5 was very quick. But I think that's abated, and I think a lot of that short interest is gone. And now probably people are sitting on the sidelines somewhat cautious. The right thing to do is to wait and see what happens if we get back down to that 88 level. By the way, if we do, I think it's going to go through it like a hot knife through butter. Whoa. But if you're being prudent, that's what the correct thing to do is. I mean, you're in no man's land right here. I think you would agree with that. We could go either way. I happen to think the way we're going is lower. Now, a lot of you people say, wait a second, you just said bond yields are going higher. If you're right about that, the dollar should follow. Yes, in the textbooks, it should follow. In my world, it's not going to follow. I think you're going to see a continued divergence between yields going higher and the dollar going lower. And what do I call that, Dan Nathan? You know me so well.
I have no idea.
A witch's brew. You knew the answer and you chose not to say it anyway.
All right, let's do this because I'm going to hit Bitcoin and ETH really quickly, and then we're going to bring Chris in. And then I want to summarize a little bit because then I want to get Chris's take on this. So this chart, is pretty widely followed. It broke out the Coinbase IPO listing, a lot of positive sentiment. That is the Bitcoin. That is the 1 year. It held that uptrend. It doubled at its highs, or was up more than double at its highs just a few weeks ago. That uptrend that it's contending with right now, keep a close eye on that, because I know that there's a lot of technicians who are saying below that, you get to that breakout level from February, which is down at 40,000. As far as crypto sentiment is concerned, that doesn't mean a whole heck of a lot to me, because look at the divergence. We have ETH, Ethereum, which is basically right back at its all-time highs, and hasn't really meaningfully tested over the last few weeks that breakout level from March or so. So there seems to be a divergence between these two. And then if you think about Ethereum, it's up more than 200% this year versus Bitcoin's more than 100%. So it's lapping Bitcoin here. There seems to be a lot of positive sentiment there. All right, really quick, Guy, to recap. The two of us think S&P probably retest that breakout level down there like 3850 or so, correct? The Nasdaq 100 potential double top here hasn't tested since mid-March, that kind of 200-day, or threatening that a little bit. So it's about 12-13%.
12,300-ish. And the Russell and the IWM small cap RTY, whatever you're looking at, that is what you should be laser focused on, people. To me, that's going to be the leader of the pack, if you remember that great song.
And then the last bit I'm just going to say is that your little witch's brew, I did know that. I just wanted to get you triggered a little bit. So if you think rates are going higher but the dollar lower, that's your little brew. To me, I just don't think that rates are going meaningfully higher above 2%. That's just me. And I think that a lot of this inflation that we're going to talk about with Chris in a second, that we're seeing in ags and seeing industrial, I do believe is going to be transient. I think a lot of things are going to kind of revert to the mean when we are on the other side of the pandemic, hopefully in the back half of this year. So with that said, Guy Adami, bring him in.
Christopher Vechcio, the senior strategist from Daily FX. He's been with us a number of times. He's a senior strategist, but he has a youthful glow about him. Chris, how are you today?
I'm doing well, gentlemen. Thanks for having me on.
So you heard all this ranting and raving we've been doing. I know you brought some charts, but as we slide it, Earl, and take a look at your first chart, you want to sort of opine on some of the things we talked about?
Sure. You guys were just talking about a potential rise in yields. And if there's a reason to think it's coming, perhaps it's due from the tail wagging this dog. It's the cost push inflation. We're seeing that food prices are rising rather rapidly here. Wheat has been limited up a number of times the last week or so in the course of daily trading, as have corn prices. Both of these moving on for, a number of reasons. But I think there are two factors that are coming into play from the macro point of view that we want to pay attention to. First, China is recovering from this African swine flu. So their pig population was decimated. They're now bringing in a lot more grains to feed their pigs as they restore this population. And the second is, as actually I saw someone respond to that thread from Joe Weisenthal this morning on ag prices, this is a problem because of a lack of supply available. This is a step function economics problem where, because they had to reduce the availability of, say, like sawmills for lumber, these companies aren't willing to come back online yet until they know that there's going to be sustainable demand. So it's not just a simple, well, let's produce an incremental, extra ton of copper or, an extra bushel of wheat. It means planting a whole new field. It means a whole new set of fixed costs.
And I want to stop you there real quick, and I want you to continue. But, historically we say, what helps higher prices, the cure for higher prices in commodities is higher prices. In this case, that's going to be true to point. It's not true now for all the reasons you just said.
Right. And we need to see some demand come back in here. So there's certainly some supply constraints, and that feeds into the narrative that we're going to get higher inflation here in the near term. Now, there's a base effect in play, of course, that the Fed's been talking about. I think it may run a little bit hotter than people who are anticipating for the next few months. And that plays to the comments you guys were just talking about with yields. Yields can still run higher. The 10-year can probably get back up to the 2% area or so. But even then, currency hedged yields right now for foreign investors are still near multi-year highs. So if you're in Europe, you're in Japan, you're going to want to exchange your currency, buy dollars, buy those US Treasuries. And so I imagine there's some sort of natural ceiling, even if yields do perk up a little bit more from here.
Chris, what is your take if this inflation that we're seeing in a lot of these commodities, both ag and industrial, persist here, and we continue to see companies raising prices? So really, it's either going to be a hit to their margins, right, or they're able to pass it through to consumers, which is a hit to their balance sheet. Do you think that the Fed, by the summer, we had Mike Wilson on Fast Money last night from Morgan Stanley, who I think is a very astute strategist, say that if this were to persist, that by the time we get to their annual meeting in Jackson Hole in late August, like the market's already going to be pricing in a taper. And so I'm just curious what your thoughts are there. And is this something that we're going to have to contend with, or that at least the equity markets that Guy and I are very focused on are going to have to contend with? And we know that the rates market's going to move ahead of that, if that's what the perception is.
I think so. I think, using last week's Bank of Canada meeting as a guidepost, they announced a taper, somewhat expected, but also somewhat out of the blue. I think that the taper was expected in a few months' time, not so quickly. And they're doing so before, their economy's gotten off its feet, before its vaccination rates have improved. James Bullard, the St. Louis Fed president, did something interesting, kind of putting out a ground marker there for us to look at, which was 75% vaccination threshold for the United States. And then the Fed would start tapering. So as we continue to see progress along this front, that really begins to put the markets in a position, a bit of a bind, where we see a potential threshold coming that could be reached that triggers the Fed to taper. And given where we stand right now, we're probably going to get to 75% if we continue along the current trajectory by September. And September happens to align with one of those big meetings. So it's very possible we're there.
Which is fascinating that he said that. I was shocked that he said it, because that does not line up with what we heard from Jay Powell, a month and a half, 2 months before, when he effectively said you got nothing to worry about until sometime in 2023. So something ain't right. I mean, they're putting test balloons out there. And my sense is they'll backtrack on the Bullard comments the closer we get. But the fact that he put it out there to me was fascinating. I'm glad you brought that up, Chris.
It's not just Bullard. Bostic has also made comments in the past that they've been quick to, put the genie back in the bottle. They've been very careful trying to curate this messaging. I'm curious to see what they say tomorrow. It's one of these inter-meeting meetings. We don't have new unemployment growth, dot plot, if you will. So it's not as exciting. But then again, we've seen that there's been a careful herding of cats with the Fed the last few weeks. I imagine that they're continuing to tailor their message very closely as we move forward.
I'm sure you didn't watch I'm sorry, Dan. I was going to say quickly, I'm sure you didn't watch the Fast Money last night when Dan fricasseed me on copper, but I know you do have a copper chart here that you want to speak to.
There we go.
So maybe you can clarify some of the things that we've been talking about.
Listen, I've been talking about copper long for several months now. There is a fundamental narrative here, and in part, it's the electric vehicle narrative, right? So if you think that we may get some stimulus coming from the Joe Biden administration, and it's going to be geared towards infrastructure, copper's in great demand there, but also the electric vehicle revolution itself. An average diesel car uses about 18 to 20 pounds of copper. An electric vehicle uses 10 times that, roughly 18 180 to 200 pounds of copper, thanks to all the wiring. And so if you think that we're moving in this new direction with a new type of energy economy, then there is a reason to think that there's substantive demand behind copper here. Again, are they going to open up new copper mines right now in the near term? Probably not. There probably is a sustained bid here. Do you want to be playing the commodities directly themselves? If you're a trader, perhaps, but if you're more of a long-term investor looking to the equity market, getting back in on dips for a Freeport-McMoRan, that may be interesting from a certain perspective.
So, Chris, obviously copper, it seems like a lot of macro investors spend a lot of time on it. Is that one of the ones that you really like to key on here? And when you look at this sort of, and listen, you have mentioned it on the macro setup on a couple instances over the last few months for these secular kind of reasons. And now obviously infrastructure is given it this other bid here. Can you continue to play it to those 2011 highs? And the only point I mentioned is when we look at those charts, like, Freeport or Cleveland Cliffs, they look like over a 10 or 20 year period, you have these moves where they go from a hat size to, up, 1,000% or something like that. But then they correct 85% at the other end of the cycle. So I guess my point is like buying them up here like this, you better be an agile trader, I guess is my point. And then lastly, what, is it as important of an indicator as it is to a lot of macro investors to you?
I think it is. Typically, you see commodities, these base metals, gain during the periods of the initial recovery during a cycle, right?
Yeah.
No one looks back at the 2008 to 2011 window thinking that was the period of prime growth out of the global financial crisis, and yet that's when copper did its best. It's really the years afterwards that the economy started to gather pace, and it really gathered the most pace in 2017, 18, 19. My perspective here, as someone who's looking at copper, and really with an FX perspective, is what type of currencies do well when copper does well. And that's why, looking at something like the Mexican peso, the Chilean peso, even against other currencies that are kind of wonky, like why would we look at Mex yen? That's not a typical pair. But
Let's do it. Why would we? Why would we look at that?
Why not?
Talk to us.
But it plays to a theme, right? Where, the Mexican economy, they export a significant amount of base metals. In fact, they export over 50% of their base metals are silver. And so if silver prices are due to benefit perhaps from higher inflationary pressures, Mexican peso exposure could be beneficial moving forward. And so I think there's a lot of interesting ways to express these themes right now. But if you're buying the futures itself, like you said, you have to be very agile because we can see big price swings, very short, quick orders.
Yeah, so I look at this chart, though. I look at this chart. I see a breakout here coming. I see what you see. I see your lines. I look at that RSI. Is that what you got in the bottom? The bottom?
MACD and Stochastics.
Okay.
MACD and Stochastics. So momentum indicators.
Kind of overbought, though. And what happens when it gets up there? It usually kind of sells off a little bit. So are you playing for a breakout here?
Well, I would actually contend against that. If you look at Stochastics in the lower panel here, during periods of intense moves directionally, you typically get overbought readings. So look at the 2012, 2013 turn of the year there. You get several weeks where stochastics stay overbought. I think we're entering a period like that again now where we see a sustained rally.
Okay.
You have a fascinating cross that not Chris Cross, not Randy Cross. You have a fascinating FX cross that you want to talk to us about. Slide it, Earl, and let's talk about this, Chris.
This year we have crude oil here, and this feeds into the next chart on the Canadian dollar. But crude oil prices themselves are seemingly poised for a bit of a breakout, right? Testing that descending trend line from all-time highs that we had back right before the global financial crisis. And when we look at a daily chart, which I didn't put together here, you can see some coiling into a symmetrical triangle. I know that you guys were talking about Chamath's tweet earlier, and he was saying that the market seems coiled. Well, from stocks, not really. It's been, 2 weeks? That seems like a very short-term perspective. The coiling, as you guys mentioned, occurred back in October, November, before the big breakout. But for energy markets, the coiling's been going on for a little while here. We've weathered the Suez Canal crisis. We've weathered the Texas deep freeze. And yet oil prices are still hanging in there. And I have to say, philosophically, if you think that there's a green revolution coming, there's an incentive to keep oil prices high, because the higher oil prices are, the better looking wind and solar appear as alternatives. They're more cost effective. So I think that oil prices are going to stay up. I think that they have a natural tailwind behind them. I think for the next few years, it's faster for a transition to a green economy if oil prices continue to go up.
All right. Last week we had Peter Bookvar on the macro setup. He made a really bullish case for silver. Do we have a silver chart here? It sounds like you think there's an interesting setup here. Talk to us. That looks like a nice little flag there.
It does look like a nice little flag. And while gold broke its 2011 high, silver really did not. And perhaps this is due to the fact that in the onset of the coronavirus pandemic, the focus was on all the liquidity brought into markets, less on the potential for economic recovery. But silver itself is used in many more industrial processes than gold. And historically speaking, it's a little bit more sensitive during periods of higher realized inflation, akin to what we had coming out of the global financial crisis. What put a stop to that rally in precious metals back then was the introduction of austerity. And that doesn't seem to be on the radar now. Instead, modern monetary theory seems to be all the rage, where we can just spend and spend.
So the exact opposite, you mean, of austerity? So it's really funny because you had mentioned earlier, like it doesn't feel like, that 2010, 11 period in Europe, it was like a rolling credit crisis, if you will. And then, where the EU was getting tripped up is like Northern Europe was saying Southern Europe, they had to be austere, right? And it was like this battle. Now everyone's like, forget all of that. That is so last decade. Guy, we're going to just print our way out of this, buddy.
Oh, you know what? You're pissing me off. And you know what? That's as good a time as any to sort of call it quits, because we can't. Listen, I know all all those modern monetary theory folks out there say we can print into oblivion and nothing's going to happen. Horse hockey, to quote the great Sherman T. Potter of MASH fame. With that, I want to thank Christopher Vechcio, senior strategist at Daily FX. Chris, how many times have you been with us now? Is this the fifth?
Right around there. This is what, half a dirty dozen, I think.
Oh, look at you, my man. I dig that. Well, you're coming back, by the way. I also want to thank Dan Nathan, who joins me on this Odyssey every Tuesday. Thank you, Dan Nathan.
Hey, it's my pleasure. And it's great to have the IG US crowd following us, and also your daily FX folks here, man. Listen, you're great on these charts, Chris. I know that we try to tell a story with these things. It's really fun for us to kind of switch from our equity-centric hats into your kind of inflation-driven world as it relates to these industrial commodities, ag commodities, some of these crosses, and obviously rates. So thanks for joining us, man. We really, Guy and I learn something every time you guys are on. Every time.
Always a pleasure. Thanks for having me.
I also want to thank our presenting sponsor, IGUS, one of the fastest growing foreign exchange dealers in North America. Dan, thank you. Christopher, thank you. And our audience, thank you for joining us. We'll see you next Tuesday.